Hi, I'm John Peterson. As we near retirement, limiting the risk on our hard-earned savings becomes an increasingly higher priority. But in our unpredictable economy, especially under the threat of increasing healthcare costs, simply protecting your savings is not enough. You need to grow your savings while minimizing the risk of loss. One of the traditional methods of growing your money is through stock market investments, but that will expose your investment to market risk. The modern stock market is no longer a place of stability for the average investor. From 1999 to 2009, there were gains in the market, but there were also massive losses. Many stock market gains that investors earned over this time period were wiped out in as little as 10 weeks. After a volatile decade, on average, their original 1999 investment dollars were worth 86 cents by 2008, an average loss of close to 15%. But the average annual return over this period, excluding losses, shows the power of fixed indexed investing. If you avoided all losses and simply earned nothing over the 4 negative revenue years, 2000, 2001, 2002, and 2008, your annualized return over that same time period could have been well above the average of 6.8%. Added to the money we lose is the time we need to recover. Between 2008 and 2009, the stock market lost 40% of its value. We would need to make close to 15% for the next 5 years, not including taxes, fees, and expenses, just to catch up to those losses. You can remove the risk of investing with a contractual guarantee to credit your money at an interest rate based only on the growth of a stock market index, such as the Standard & Poor's Stock Index 500, the Dow Jones, or the NASDAQ. This guaranteed growth eliminates stock market losses, and by leaving funds on deposit, we defer any tax liability. The U.S. Securities and Exchange Commission reports over $200 billion are currently deposited into these contracts by millions of investors. No deposits have been lost or exposed to market risk because they're not invested in securities. The market index is only used to determine the interest rate that's credited to your invested money. When the index increases, a portion of the interest rate gains are credited to your savings account. When the market decreases or loses value, losses are never deducted. Your earnings are preserved and protected. However, there's a maximum limit on how much of the index gains can be earned. If your contract is for 10 years, it allows for your funds to grow at a tax advantage. This is called a tax deferral. Plus, at any time, you can convert your account to a pension that you can never outlive. And you can include your spouse if you wish. These contracts do allow you access to your money should you need the funds, even after 1 year. So now you're wondering, what are those contracts? Well, they're fixed indexed annuities. Fixed indexed annuities are issued and contractually guaranteed by legal reserve, which means insurance companies are required by state law to maintain capital reserves equal to all of their contracted guarantees. The insurance company assumes the risk, not you. In addition to never exposing your important money to risk, annuities have a very unique feature called income riders. Some income riders will guarantee an interest rate of 5 to 6% annually, some even higher. Then, when you access your income, the funds are guaranteed, even for as long as you and your spouse live. A pension for life. Now might be a good time to investigate whether a fixed indexed annuity makes more sense. You can learn more about fixed indexed annuities and other safe money retirement strategies by requesting a copy of our Best Annuity Rates Report and Safe Money Guide. Thanks for watching.